$1,200 a year per family, and $187 billion a year in total. That is what the Merchants Payments Coalition estimates this system costs. A fee that has never appeared on a single receipt. It is called the Visa interchange fee. Every time you buy groceries, fill a tank of gas, or pay for a coffee, a percentage of that transaction is taken before the merchant receives it. Visa sets the toll. Your bank collects it. The store bakes it into the price tag. You already paid it before you walked in. In 2024, American businesses paid $187 billion in card processing fees, according to the Nielsen report. That is more than the combined revenue of Coca-Cola, Nike, and McDonald's. The number grew by 70% since the start of the pandemic, and Visa does not technically collect most of it. Your bank does. On Visa's terms, in the next 20 minutes, you will see three things. How a 1958 experiment in Fresno, California made interchange permanent. How rewards cards quietly pushed that fee toward 3%. And the contract clause the Department of Justice says makes leaving Visa financially impossible. Here's how the fee was born. In 1958, Bank of America ran an experiment. Without asking permission, it mailed 60,000 unsolicited credit cards to residents of Fresno, California. The card was called Bank AmeriCard. It was the first general-purpose credit card that placed a third party between buyer and seller. Before Bank AmeriCard, merchants either ran their own store credit or dealt in cash. This card promised something different, a single piece of plastic accepted at any participating business, with the bank guaranteeing payment. But that guarantee needed a business model. If Bank of America was going to pay the merchant upfront and collect from the consumer later, it needed income from the transaction itself. The solution was a small percentage fee on every sale, routed from the merchant's bank to the cardholder's bank. That fee was interchange. It solved a genuine problem. Without it, no bank had an incentive to issue cards. Without cards, no merchant had a reason to accept them. The fee was small, the logic was sound, and it worked. The Fresno experiment was chaotic. Fraud was immediate. Delinquency rates exceeded 20% in the first year. Bank of America lost millions. But the concept survived because merchants who accepted Bank AmeriCard saw higher sales from customers spending money they did not yet have. The economics of interchange were validated before the system was even stable. Once merchants saw sales jump, the system went contagious. By the mid-1960s, Bank of America was licensing its card to regional banks across the country. The more banks joined, the more merchants accepted. The more merchants accepted, the more consumers wanted one. By 1976, Bank AmeriCard had been renamed Visa. Hundreds of banks were issuing the card. And interchange was no longer a startup incentive. It was permanent infrastructure, invisible to the consumer. That fee was never designed to be permanent. But before we get to how it grew, you need to understand why no one can leave. Because the fee is only half the story. The other half is the contract structure that makes it nearly impossible to walk away. According to the Department of Justice antitrust lawsuit against Visa, filed in September 2024, Visa uses a pricing structure that regulators call cliff pricing. Here's how it works. Large banks and payment processors receive volume-based discounts from Visa. If a bank routes a certain threshold of transactions through Visa's network, it earns a rebate on each one. But if the bank falls below that volume threshold, the rebate does not shrink proportionally. It disappears entirely. Every transaction reprices, not just the marginal ones below the line, all of them, the entire volume. The Department of Justice alleges this creates a structural switching penalty. A bank routing 90% of its debit transactions through Visa cannot experiment with sending 5% to a competitor network. Losing that 5% could push total Visa volume below the threshold, eliminating the rebate on the remaining 85%. The cost of testing an alternative is the loss of the existing discount on everything. For a major issuer processing billions of dollars, that is a bet no risk committee would approve. The cliff does not punish disloyalty. It punishes curiosity. And the federal complaint goes further. It alleges that Visa entered into agreements with companies positioned to become competitors. According to the Department of Justice, Visa did not just beat competitors, it paid the most dangerous ones to never build a competing rail. The filing names Apple, PayPal, and Square. These were not licensing deals. They were agreements to ensure those platforms would route transactions through Visa's network instead of building their own independent payment rails. Apple Pay was introduced as a new way to pay. According to the Department of Justice complaint, it became another channel that processes transactions on Visa's network, under Visa's fee schedule. The government alleges that Visa paid potential competitors not to compete. According to the federal government, the barriers to building a real alternative are not technological. They are contractual. If this is the kind of analysis you find useful, consider subscribing. This channel covers the financial mechanisms and contract structures behind the systems that affect your daily life. No speculation, just the documents. That is the trap. Now here's how the fee inside it grew. And this is where most people start paying attention, because this is where it starts costing you money. In the 1980s, banks discovered they could create card tiers: standard cards, gold cards, platinum cards. Each tier offered better perks to the consumer: cashback, airline miles, hotel points, and each tier carried higher interchange for the bank that issued it. The consumer saw rewards. The merchant saw a larger deduction at the register, and the consumer had no reason to notice because the fee was never printed on any receipt. Here is how credit card processing works today. On a $100 purchase, about $1.75 goes to the issuing bank as interchange. About 18 cents goes to Visa as a network assessment fee. About 7 cents goes to the payment processor. The merchant keeps roughly $98. Now imagine every receipt had one extra line. Card toll, $2.35. If that line existed, the system would not survive a week. But that $1.75 is not a fixed number. It shifts depending on the card. A standard Visa credit card costs a merchant about 1.51% plus 10 cents per transaction. A Visa Signature Rewards card costs about 2.1% plus 10 cents. A Visa Infinite card, the kind that earns lounge access and bonus points on travel, can cost the merchant over 3% of the purchase. The merchant does not know which card a customer carries. They all look the same at the register. The fee is different for every single one, and the merchant cannot set different prices based on card type without risking customer backlash and adding operational complexity. Most merchants see the total fee deduction on their monthly statement after the fact, broken down by transaction category. By then, the product has already been sold at the sticker price. For a small business, this adds up fast. A coffee shop processing $500,000 in annual card transactions at an average rate of 2.35% is paying roughly $11,750 a year in credit card merchant fees alone. That is before the processor's cut, before the terminal lease, before the monthly statement fees. The shop owner sees the total and raises the price of a latte by 10 cents. Every customer pays it, including the ones using cash. The rewards points you earned on your last flight were funded by the person behind you in line who used a basic debit card. Their purchase cost the merchant less, but the merchant set one price for the item anyway. The difference went to pay for your miles. That is not an accident. The system was designed to work exactly this way. And that same cross-subsidy pattern shows up in how American homes are becoming uninsurable. Different industry, same architecture. And the scale of this one is staggering. In fiscal year 2025, Visa processed roughly 900 million transactions per day, according to its annual report. It moved $17 trillion through its network. The company reported $40 billion in net revenue and held approximately 5 billion payment credentials worldwide. In the United States alone, Visa and MasterCard together control over 80% of the credit card market. Visa publishes its interchange rate schedule twice a year, every April and October. The schedule runs hundreds of entries long, sorted by card type, merchant category, transaction size, and whether the card was physically present or used online. It is publicly available on Visa's website, and it is non-negotiable. Merchants cannot bargain for a lower rate. They accept the schedule, or they stop accepting Visa. And Visa's own corporate language is precise about one thing. It states that merchants do not pay interchange fees. Merchants pay a merchant discount to their financial institution. That sentence is technically accurate. But Visa writes the rate schedule. Visa sets the tiers. Visa determines the rules. The bank collects the money. Visa built the architecture that determines how much. Now, Has anyone tried to fix this through regulation? Yes. And it matters what happened next. In 2011, Congress passed the Durbin Amendment as part of the Dodd-Frank Act. It directed the Federal Reserve to cap debit card interchange for large banks. Institutions with more than $10 billion in assets were limited to 21 cents plus 5 basis points per debit transaction. Before the Durbin Amendment, those fees averaged about 44 cents. The goal was direct, lower the fee, create routing competition, and let merchants choose cheaper networks. Here is what actually happened. The cap applied only to large regulated banks. Small banks and credit unions were exempt, and credit cards were excluded entirely. Visa adapted. Banks began migrating consumers from basic card tiers into premium signature and infinite categories with higher interchange rates. Nearly every major bank now issues cards classified as premium by default. Volume on capped tiers shrank and volume on uncapped tiers grew. The regulation created the incentive to upgrade every card in America. In 2014, Visa and MasterCard credit card interchange totaled $39.1 billion. By 2024, that number reached $111.2 billion, nearly 3 times higher in 10 years, during a period when Congress was actively trying to bring fees down. Total card processing fees across all types hit $187 billion. The regulation targeted one component, and the system repriced around it. Merchants sued to negotiate. In 2005, more than 1,200 retailers, including Walmart, Home Depot, and Target, filed a class action accusing Visa and MasterCard of fixing interchange rates. The case took over a decade. They won money. The final approved settlement was $5.54 billion in 2019. They did not win rate control. In March 2024, Visa and MasterCard offered a new injunctive settlement proposing to lower rates by 4 basis points for 5 years, with estimated savings of $30 billion for merchants. The court rejected it. A revised version filed in November 2025 remains pending. Then came September 24, 2024. The Department of Justice filed a civil antitrust suit against Visa in the Southern District of New York. Case number 1, 24 CV 7214. It was the largest federal debit antitrust action in American history. Attorney General Merrick Garland announced the case publicly. On a $100 purchase, the European Union caps the interchange fee at 30 cents. In the United States, the average is about $2.35. What Garland alleged is that Visa's conduct affects not just the price of one thing, but the price of nearly everything. The complaint names cliff pricing. It names the fintech agreements. It names the volume thresholds. It alleges Visa collects more than $7 billion annually in debit interchange from a market where it holds approximately 60% share. MasterCard holds roughly 25%. In June 2025, a federal judge rejected Visa's motion to dismiss. The case moved into discovery. As of February 2026, fact discovery is scheduled to close October 2026. Expert discovery runs through April 2027. No trial date has been set. Both sides are litigating. In January 2026, the Credit Card Competition Act was reintroduced in the United States Senate. The bill would require banks with over $100 billion in assets to offer merchants a second network option for routing credit card transactions beyond Visa or MasterCard. It was referred to the Senate Banking Committee. It has not advanced past committee. Meanwhile, much of the world already operates under different rules. In India, the UPI network processes billions of transactions at near zero cost to merchants. In Brazil, the PIX system moved the country off card-based fees entirely. In Norway, BankAxept handles domestic payments outside the Visa network. The federal government even built a domestic instant payment system called FedNow. It launched in July 2023 as a real-time settlement network operated by the Federal Reserve. It allows banks to transfer funds instantly, 24 hours a day, 7 days a week, without routing through Visa or MasterCard. No interchange, no network assessment fee, no cliff pricing. It exists, it works. And widespread adoption by major banks has not followed. The infrastructure to bypass the interchange system is already built. The institutional incentives to use it are not. Banks earn billions from interchange. FedNow earns them nothing. There is one part of this story that does not have a clean answer, and it is the part most likely to start an argument. If interchange fees were capped or eliminated, rewards programs as they exist today would almost certainly shrink. The cashback, the points, the travel perks. They are funded by interchange revenue flowing to issuing banks. Critics argue this creates a cross-subsidy. Consumers who pay with cash or basic debit cards are paying the same prices at the register as consumers earning 3% back on a premium rewards card. The rewards are funded, in part, by everyone else's higher prices. Defenders argue the opposite. Credit cards reduce fraud, they speed up checkout, they increase consumer spending, which benefits merchants even after fees. They point out that handling cash is not free either. It requires counting, security personnel, armored transport, bank deposit fees, and carries counterfeiting risk. One counterfeit $100 bill costs the merchant 2.5% of the next $4,000 in transactions. Banks have also begun charging merchants a percentage fee on cash deposits, which did not exist a decade ago. The cost of accepting cash is real. It is just harder to measure than a line item on a processing statement, and nobody has filed a federal lawsuit over the cost of counting quarters. Both sides are right about the costs. Only one thing is not debated. The fee is real, and it is hidden. The question is whether a fee structure designed in Fresno in 1958 should still act as the hidden floor for retail pricing today without appearing on a single receipt. That question is now in front of a federal judge in Manhattan. The last time someone used a Visa card in the United States was about 4 seconds ago. In those 4 seconds, a FEE was calculated based on the card type, the merchant category, the transaction size, and whether the card was physically present. That fee was split between a bank, a processor, and a network, and it was added to the price on the shelf before the next customer walked in. This has been happening 900 million times a day, every day, for decades. The mechanism that started in Fresno in 1958 is now the subject of the largest debit antitrust case in American history. What happens next depends on a federal judge, a stalled Senate bill, and a fee schedule that updates every April and October, whether anyone notices or not. If this kind of financial architecture interests you, the next episode covers the insurance mechanism that is making American homes uninsurable. Same pattern, different industry, same question: who designed the structure and who is paying for it?